Now today I'm going to go over some of my trade details and specifically the screenshot line by line so you guys can see exactly what I'm looking at when I place a trade. Hey everyone, welcome back to Drawbridge Finance. My name's Levi Woods. I'm not a professional investor. I don't work in the finance industry, and this is not investment advice of any sort. I am, however, a longtime dividend investor and turned option trader, and I run this YouTube channel because I like to help people like you become more informed about different styles of trading. Now today I'm going to go over a couple of option trades that I did recently on Coca-Cola, and let's just jump right into it. One of the easiest ways to search Patreon is just through the search bar. So I've just typed in KO, and the reason we're looking at Coca-Cola today is because it's a really low cost stock. I mean, to buy 100 shares of it is only about $4,000, and so that means trading options on it requires even less money. So even people with smaller accounts can trade options and make a substantial return when they play on stocks like this. Now, of course, my Patreon page is by date, so I'm gonna skip over this last post, which is where I was closing, and I'm gonna go to the entry. Now, this one was made on August 3rd. I like to keep these posts relatively simple, so I have a minimal amount of text, and most of the details here are in the images, and that's what we're gonna go over today. The title is New KO Options. It means I'm opening a new position, and here's the details. I hope that this will become a strangle if Coca-Cola has an up day this week. If it goes down, I may double down on this position. Right in the description, I've told you what I'm gonna do if the stock goes up or if it goes down. Now today's trade, sell to open, KO September 18th, naked 43 put. The negative denotes that I'm short, and we can see that because I'm selling to open anyways. That's the position that I'm gonna be holding as a short position in my account. So when I short sell, I'm selling, which means I'm collecting a credit at the beginning of the trade. The credit I collected was 52 cents. Now, what did I get 52 cents for? Well, I'll show you. Here are the details. I click on this image and we can look at KO up at the top. This is Interactive Brokers. For any of you who don't know this platform, it is a fantastic brokerage. It's the only low fee option really in Canada for trading options. So if you're not using Interactive Brokers, you're probably paying too much for fees. So now let's take a look at the details. Coca-Cola on this particular day was trading at $46.51. By selling a put, I am opening a contract where my obligation is to buy 100 shares of stock at an agreed upon strike. So the agreed upon strike in this case is $43. Now, if you notice, that's $3.51 below the current value of $46.51. Now, how do I determine that? Well, I typically sell puts in either a 16 to 30 delta range. So all we have to do is look at the delta column here. So here's the delta, and that 43 put has a delta value of 20, which is exactly in range of where I want to sell an open put. There's lots of volume on here, almost 8,000 contracts as open interest. And there was 117 already traded that day of this particular put prior to me even opening my trade. So down in the strategy builder, because I've clicked on it here, I can see the details of the trade. So I'm selling one contract September 18th, 2020 with a strike price of 43, and it's a put contract. The delta is 20 and the theta is 0.013. What this means is if nothing changes with Coca-Cola, if the IV doesn't change and the stock price doesn't change, then this option is going to decay in value by $1.30 per day. And so we can kind of predict forward how much money we're gonna make off of this if we hold to expiration. The next thing here is the bid ask, and that's 0.51 to 0.54. We've got some people making bids to buy and some people asking to sell. I'm asking to sell, so I'm hoping that I'm gonna get a credit somewhere in the mid price here, probably either 52 or 53 cents. Now, let's go over the details here of what actually happens. So we can see that same thing I was just talking about, the bid ask, the 51.54, the size of the contracts, and this is the number of contracts that are either being bid on or asked for. The risk to return ratio is very, very, very low. I am risking a max loss of $4,249 to make $51. Now that sounds pretty counterintuitive, but remember, in order for me to lose the whole $4,249, Coca-Cola would have to go to zero, and that's pretty unlikely in the next month. I mean, it could go to zero, but it's pretty unlikely. So that's why this risk to return ratio is so low. I've got $51 compared to $42.49. But the probability of profit, which we refer to as the POP, is very, very high. Now that's the beautiful thing about being an option premium seller like this, is that most of the trades that we enter can have this very high probability of profit. So even though you're making a relatively small amount on each trade, you have a very high chance of actually being profitable on almost every trade that we make. Now the aggressiveness is unknown, so that's a line I don't even use, so we're just going to skip right over that. Now the break even, this is super important. This is how much the stock would have to hit before I was actually losing money on this trade. And how it's calculated is the difference between the strike of 43 minus the credit received. So at this point, it automatically calculates that it's going to be 51 cents or $51. And you can see that 43 minus 51 gives us this 42.49. Which means that if Coca-Cola stays above 42.49, I will make money. And if it goes below 42.49, I'm gonna have to either close for a loss, I'm gonna have to roll it out in time, or I'm gonna have to be assigned the shares and buy them at $43 and hope that it recovers. I could also sell a covered call at that point, which would be a fine way to handle this trade. This is the big one here, the margin. Now, in my account's in Canadian dollars, so this is just over $1,000 US, but this is showing me $1,400. So this is an interesting thing about options, is we're actually making money off of margin rather than the full funds having to be in our account. So in order for me to buy 100 shares, it would cost me $4,600. But in this case, I actually only have to allocate $1,400 Canadian towards this particular trade. Now this can be a bit risky, so we never let our margin fill all the way up to the max. We always play much smaller percentage of margin in our account so that we have ability to let that expand when it's necessary. Now here's a performance graph. Now this is pretty straightforward. Basically, at this point right here in the center is gonna be that price at 42.49. That's where it starts making money or losing money. And you can see that if it's above $43, then I'm going to make the $51. Doesn't matter what price the stock is above 43, this trade would make $51. Now, if it starts to go below, the further it goes down, the more money I lose. So these are the scenarios. Really, the big thing that I look for here is the profit and loss. If the stock moves 30% to the downside or down to $32.58, my loss on this will be $1,027. If it moves down to $37.23, we've got $569. So these are just the details of this chart up above. And this is dated, so you can actually change this. So if it jumped up today, I would be able to profit $45. Now, the other thing that I do is I send along this little chart. So you can see here, this is kind of the daily moving averages, and this purple line is our 200-day moving average. You can see why I was selling a put, because we were getting down into this range where Coca-Cola was close to the 200-day moving average, and what I wanted to do was play it safe. So I've put a line on here at $43, and you can see how long it's been. Like, it's been a while since this has touched down at $43. So this is a relatively safe play, and I use that in conjunction with my delta value of 20 to pick this strike. So my hope is that once it comes under this 200-day moving average, that we're gonna start to see it rebound up, and I'm gonna make some money on the upswing. Now I send another image, and this is probably the most important one. The underlying, I've got this listed as KO with a September expiration, and that's just for my own personal reference. And then the position description, it's a naked 43 put, and it's short, which means it's designated with a negative here. The original transaction date was August 3rd, and that's when I made this post originally. The 52-week implied volatility rank, which is super important. I usually trade stocks that when they're trading above 25. Now with Coca-Cola, I'll take exception because it very rarely has those huge volatile days. So in this case, it was trading down at 14, which is outside of the normal range. The option expiration date is September 18th, and the initial credit per contract was 52. Now you'll notice on the last sheet we were talking about 51 cents, but what I was actually able to fill was 52 cents. The number of options in this strategy, 1, the number of contracts, 1, and then the margin requirement, and I listed here in US dollars so that we can compare apples to apples throughout. So $52 on a $1,091 worth of margin, and that's how we calculate our annual return, because that's the amount of money that we're actually allocating towards the trade, and then we can reuse that money each time we put on a new trade. So the blue section tells me how much I would make if I hold it to expiration. Now I have no intent of holding it to expiration most of the time. I'll get to that in a moment. So days to expiration 46, the premium collected $52. That is the 52 times 100 because there's 100 shares in each contract. The premium received minus the fees, pretty simple. 51.35 is a calculation of 52 minus the 65 cents. The projected daily profit or loss is $1.12. Again, really simple math here. So 51.35 divided by 46 gives us this $1.12. Means we've got a projected return on investment of 4.71. That's the $51 as a return of $1,091 that we're allocating towards the trade. So the projected simple annual return, if we did this trade over and over and over again, would be 37%. Not bad, 37% without buying Coca-Cola stocks at all. But we can do one better, so I'm going to show you how that works. Now, if we compounded this money, it would actually be 44% return. So those are two different percentage estimates. Now, this is the most important part of any of my trade alerts. This is the buyback target ranges. When I put on any trade, I tell everyone exactly what my intention is of when I can get out of this stock for a reasonable value. So the buyout for 50% of max profit is going to be 25 cents. It's usually slightly less than half the premium that I collected. So you can see that 25 cents is just a little bit less than half of 52, which would have been 26 cents. And then the buyback for 2 times loss will be around 3 times the price of the initial credit. So $1.53 is around 3 times the 52. Now this spreadsheets that I have for sale, if you guys are interested in it, you can go to my Etsy store, you can check it out and download it. It's the quick option calculator with summary sheet, and it keeps all my options in track so that I know what I've got open and I can see these buyback target ranges at a glance, and I can just trade for 15 minutes in the morning if I want. Now I'm going to show you a different type of trade, and that's a strangle. Now the nice thing about this trade is that it was actually a public post that I made on Patreon, which means anybody that follows my Patreon page, free or paid, could have seen this post and we could have made money together, which is amazing. So if you don't already follow me on Patreon, go over there, click follow, because it's free to do that. And if you decide later you want to support the channel, you can. You can sign up for all of my trade alerts. Here's the post, June 29th, new KO options. One of my old standby trades on Coca-Cola, simple strangle with a bullish skew. So the stock was obviously trading a little bit down that day when I was expecting some upside move. So that's why I put on a bullish skew, and I'll show you how I did that. So today's trade, sell to open, KO, August 21st, strangle. I'm selling the 42.50 put and I'm selling the 50 call. I collected a credit of $1.64. Now, one of the things about this type of trade is that there is unlimited risk to it. That call side is very, very dangerous. And that's why I decided to put on a little bit of a bullish skew, and which gave me more upside potential before the risk kind of kicked in. So we can take a look at the actual chart and we'll go over this. So you can see here in my window on the left, here's the calls. August 21st, we've sold the 50 call and we've sold the 42 put. So this is the put side, this is the call side. Down here again, strategy builder, we can see what we're doing. Sell August 21st, 42 put, sell August 21st, 50 call. The delta, we can see we are selling a 35 delta put and only the 13 delta call. And so that kind of shows you that skew that's built in. Obviously a lot more risk on this particular trade to the put side. The bid ask, so you can see the range at this particular time was between 172 and $1.64. And what did I say I collected on this? I collected $1.64. So I actually got in right at the low range of this, but that's okay because that was the trade that I put on, and that was the premium that I was able to collect that day. Now here we go on the right hand side, which is what we're looking at, this profit loss chart. So we can see this potential unlimited or nearly unlimited loss on the downside. Now, because I'm selling a 42.50 put, that is actually limited on the downside to about $4,250 minus the credit received. So around $4,100 would be the limit if Coca-Cola went to zero. Now on the upside, it is unlimited. If Coca-Cola started to just keep going up and up and up, I would continually lose money. So we can see on the chart down here, we can see those expected moves, how much profit or loss, $1,000 negative on this trade if Coca-Cola drops 30%. Also $600 loss if Coca-Cola goes up 30%. So the sweet spot is going to be right here in the middle, and that's kind of our target zone. So the profit probability 66%, maximum return $165, which corresponds to the bid ask. On my trade, it was only a 164. And then this max loss unlimited, and that's because of that naked call that we're trading. This is what's super important here are the break evens. So $40.85 and $51.65. That's where this chart is crossing over this zero line. This is $40.85 and this is $51.65. If the stock stays in between those two numbers, then we'll have some sort of profit. And I've also marked them here on this chart so we can see that upper limit, 50, and which Coca-Cola had touched before, and then the 42.50, which is down here. And you can see why I put on this bullish skew, because we were trading in this range, and I expected this stock to kind of rally back up. So here we are, that's when I put on the trade right here, and exactly as expected, this stock rallied up. And that's because we've got this relatively flat moving average that we look at, and we know that in order to maintain those moving averages, the stock has to trade on either side of it. So this is a time where I want to sell either a put, or in this case, I wanted to sell a strangle, knowing that I was likely that it was gonna have an upside move. Annually, if I did this repeatedly and I reinvested the money, I can make up to 121% return compounding. Now let's take a look at what actually happened, because this is amazing. I held it for 22 days, and on July 21st, I actually closed it, and the buyout cost was 44 cents, which was well below the 80-cent target that I had set. And so the realized profit and loss was $117. That works out to $5.34 per day. And this is pretty amazing, 146% return annually. Now, these are the type of trades that I'm posting on my Patreon page for both my free followers and my paid patrons. So if you're interested in checking that out, you should. You can also follow me on Facebook or Instagram, or what else, here on YouTube. Leave a comment down below. Anything really. I'll try to get back to everybody's comments, everybody's questions, so we can all get rich together. Thanks so much for watching, and we'll see you very soon.